Welcome to DCE Digital Learning. I am Taramani S. Welcoming you to one more session, which is session number 12 in the third unit of the subject Accounting and Financial Management, a subject prescribed for third semester BCA. And in this session, we'll learn about one more topic, that is journal proper, and we'll learn about the theory and problems both regarding the same. We have already learned about subsidiary books in the previous units, and we learned there are 8 subsidiary books. And out of that, you have learned already purchases book, purchases returns book, sales book, and sales returns book, and the bills receivable book, bills payable book, and cash book. So all the related kinds of transactions will be entered in those subsidiary books. But certain transactions are there which can't be entered in any of those 7 subsidiary books which I told you just now. So such transactions are such kind of transactions which we can't enter in those 7 subsidiary books, which will be entered in a book, that is the 8th subsidiary book, that is what we call journal proper. And then this journal proper will enter certain kinds of entries, that is what we call opening entries. That is opening entries means which we have to end, which we have to pass in the beginning of the year. That means the closing balances of the accounts of assets and liabilities will be brought to the new year as the opening entry for this year. Then closing entries, that means certain accounts have to be closed to so that it has to be posted to certain accounts. Then adjusting entries, this is what we call the entries to be passed, which we find in final accounts in the problems like adjustments. And usually the first adjustment will be closing stock, then outstanding expenses, prepaid expenses, outstanding incomes, like that. Then transfer entries, that is those entries, the amount of which one account is transferred to another account. Then rectification entries, which we passed just now in the previous session regarding rectification of errors. Then miscellaneous entries, that means certain such kind of entries which are not coming in those 5 kinds of entries, and which we can't enter in those 7 subsidiary books also, like maybe bad debts, depreciation, then receipt or issue of promissory notes, and entries regarding dishonor or renewal or retirement of the bill, which we learnt it in bill of exchange related sessions, are to be called as miscellaneous entries, and we have to enter it in journal proper. First, look at a problem which is regarding opening entries. That means the first entry which we open when the new financial year is being started. The question is the position of Mr. Murthy on 31st March 2001. On 31st March 2001 was as follows. So the financial year is being closed. Now we have to bring it to the new year, that is 1st April 2001. This is the first day of the new financial year, and the related items are given as cash in hand 1100, cash at bank 13900, stock 25,000, furniture 9,000, plant 15,000, debtors 15,000. See, all these accounts what I read just now are related to assets. Then creditors 16,500, which is a liability. So all assets are to be debited, which we know it already, and creditors is a liability which is to be credited. Then the entry will be just write the format of the journal, then write the heading journal proper of Mr. Murthy. This is the entry for opening. So 2001 April 1st. So see, all the accounts debited here are related to assets, cash in hand at bank, stock, furniture, plant and debtors. So all these accounts are being debited. Then creditors is a liability, so it has been credited with the relevant amount. Then find the total of assets and less 16,500 the amount of creditors. The remaining amount comes to 60,000, and this is what is the amount to be transferred to capital account. And you know it already, capital account is the first item, that means the item to be written on the credit side. Then write the journal, that is the narration is being the opening entry. Opening balance is brought into account from previous year and balancing figure being the capital. And this entry is what we call opening entry. Then what is this closing entry? See, at the end of the year, we have to pass the entry to transfer it to the relevant accounts, and that entry is what we call, this is closing entry, and they are related to purchases, sales, opening stock, and these are to be closed to be transferred either, that is which facilitates the preparation of final accounts, that is for the preparation of trading account and profit and loss account. So look at this problem. Pass the closing entry from the following ledger balances picked out of trial balance of Mr. Anant as on 31st December 2002. So this is the end of the financial year. The accounts are to be closed now. These accounts which we have to transfer it to the concerned account, purchases account, sales account, opening stock. So these are the amounts related to, as you know, trading account. Then gross profit also comes in trading account. Rent paid comes in profit and loss account. Interest received account comes on the credit side of profit and loss account. Then how to pass these entries? This is a very simple entry, just as you learned the opening entries. So journal entries in the books of Mr. Anant, write the date as on, that is a closing date of the year, which is given in the sum. So write the format of the journal and look at the first entry. Trading account debited to opening stock to purchases account. And I'm very much sure you know passing of entries, then posting of the entries and reading out the entries. And in trading account, these two accounts comes on the debit side with the starting with the word to. So the entries are to be read as trading account to opening stock to purchases account, and it's a very simple sum, a simple one. And in the same way, sales account in the final accounts comes on the credit side with the word buy, right? So sales account means to trading account, because it comes on the credit side. Then one more is there regarding gross profit. In trading account, gross profit or gross loss will come, and if it is a gross profit means in trading account it comes on the debit side of trading account. So to a profit and loss account it will be, because later it has to be transferred to the profit and loss account. So trading account debited to profit and loss account. In the same way, profit and loss account debited to rent account, it's there. To rent account means it is an expense. That means it is rent paid. So profit and loss account to rent account, because it is an expense, we enter it on the debit side of rent account, on the debit side of profit and loss account. Then interest received account debited to profit and loss account. See, interest received account is an item of income and we write it in profit and loss account on the credit side. So the entry has to be, because it starts from by interest received account. So interest received account to profit and loss account. That means these are the accounts which are being closed to be transferred to either trading account or profit and loss account, which enables us to prepare the final accounts and complete it, so that we'll be able to know the financial position of our business. And these are the transfer related entries. What are these things? and these accounts are closed at the end of the year by transferring them to their original accounts. What are those things? See, purchases account has to be purchase returns account are to be transferred to purchases account. Sales returns are to be transferred to sales account. Okay, something like that. And the look at the problem: goods taken by the proprietor for domestic use. So in that case, it is related to drawings account. So drawings account debited to purchases account, because it is goods taken or cash say taken or whatever it is related to drawings, means properties of the business is being used by the owner or proprietor of the business for personal use. Then the second one, transfer of amount drawn by owner to his capital account 1500. So capital account is to be debited to drawings account because it is transferred to capital account. Then transfer sales returns account 500 to sales account. The entry has to be sales account is to debited to sales returns account because it has been related to transferring of sales returns account to sales account. Then one more, Ram agreed to pay the debt of rupees 1000 due to Sham. Ram agreed to pay the debt of rupees 1000 due from Sham. So instead of Sham who had to pay the amount, Ram is agreeing to pay that amount instead of Sham. So in that case, Ram will be the debtor. So Ram's account is been 1000 and Sham's debtorship is been cancelled. That is credit his account. That is credit his debtorship. That is of Sham. So credit his account. That is to Sham's account. Then the last thing is transfer of profit and loss account. Profit and loss account, debit balance of 2200 to capital account, which is nothing other than net loss, because in profit and loss account debit balance means debit side is more. So debit side is more means it comes on the credit side of profit and loss account, which happens to be net loss. So net loss being transferred to capital account means obviously capital account debited to profit and loss account. So these are what we call regarding transfer entries. And one more is adjustment entries or adjusting entries. These are all related to the items that you read while preparation of the final accounts and which will be given after the trial balance. Just below the trial balance they'll give adjustments. That means those are the transactions which are not being considered, that is before finalizing the trial balance. So those are to be considered now, and double entry should also be completed now itself. So outstanding expenses, prepaid expenses, then all outstanding and pre-received incomes, then depreciation, okay, then closing stock. Always normally the first adjustment regarding this interest past is what we call adjustment or adjusting entries. So first is closing stock 28,200. So you know it, in trading account closing stock comes on the credit side starting with the word buy. So closing stock to trading account. Then salaries outstanding rupees 700. So salaries outstanding, so it was not treated earlier. So because of that, in its place suspense account was being credited wrongly, just to artificially tally the trial balance, so debited to cancel that suspense account. So suspense account is being cancelled by means of debiting it now, and the account that had to be credited earlier properly means outstanding salaries account, so they credit it now. Then the third one, rent prepaid 200. Rent prepaid is 200, which is rent or any expense if it is prepaid means it is our asset. So all assets are to be debited. So prepaid rent account rupees 200 to rent account, because the expense will be less now, because before it, the date it comes of paying only, we have paid it. So it becomes our asset, and the amount of rent which we have to pay it next will be made less. So to rent account. Then the fourth one, commission earned but not received. Commission earned, that means we have already provided the service but not received, rupees 500. It is also an item of asset. So in this case, uh, this case, the entry has to be commission receivable account debited, because it is an item of asset, because we have already earned commission. So commission receivable account are debited to commission account. That means we have already provided the service. So commission is due from them. Okay, but we have not received it. So commission is an income for us in this case, as well as an asset. So to commission account, which is an item of income. And the last here, depreciation on furniture. Depreciation is an, we can't call it loss, it is an expense, because we are using this furniture, and because of which furniture value goes down because of wear and tear. So depreciation is an item of expense, debit or losses and expenses. Then to furniture account, because of that furniture, which is an asset, which is an account to be debited, right, because it's an asset. But because of using it, the value of asset is going down, so it has to be credited to furniture account. Then the last two kinds of entries are rectification and miscellaneous. And rectification of errors or rectification in entries we are not explaining here, because in the previous session number 11 itself, we have learned regarding rectification entries of different types, and the only one thing that has been left here is miscellaneous entries. So miscellaneous entries are those entries which can be any kind of entry, which may not find place under any particular definition, like opening entry, closing entry, or any other kind of entries. Any of the above 5 types of entries. So those are what we call miscellaneous entries. And here a small problem is given on in August 2003. Dates are given now, like first, bought computer for office from Hari Printers, 20,000 on credit. It's not been entered. We purchasing computer for office, it's coming in, and who sold it? Hari Printers. So computers are coming in, and Hari Printers are the givers of the benefit. Computers account debited to Hari Printers account. Then the equipment sold to Mahinder, rupees 5,000. So Mahinder is the receiver of the benefit, and equipments are sold. So the entry has to be Mahinder's account debited, because he is the receiver of the benefit, because we are selling him, and it is on credit, and what is going out is equipments account. Then bought furniture for personal use from Raghava, rupees 2,000. That means it is for personal account, means personal use means drawings account. So drawings account, and who sold it to us is Raghava, means it is on credit, but not for office use but for personal use. Then there were bad debts from Puneet, rupees 200. Bad debts is a loss. Debtor was Puneet, but he will not pay us, and it is guaranteed he will never pay that amount, so it is a loss to us. Then that is bad debts account has to be debited, because it is a loss. And to Puneet's account, because Puneet was our debtor, but now it is sure that he will never pay, so his debtorship is being cancelled to Puneet's account, because the reason is we came to know it as bad debts, and we are very much sure he will never pay us. Then loss of goods due to fire rupees 2000. So this has to be accounted in our trading account, and because we have to show the goods account in trading account, is it in closing stock or whether something has been done. So show it in trading account on the credit side. So loss by fire account debited to trading account, and because it is a loss of goods by fire. So these are certain transactions which is not categorized under any of the above five types of entries, and which we call it as miscellaneous entries. So this is the session number 12, and here we learnt about journal proper, and which is the last subsidiary book, and those entries which can't find place in any of those seven subsidiary books which I told in the beginning, which will be finding its place in this book, and this book is called as journal proper. And we have solved under each category, that each type of entries, one problem, simple problems, definitely for this journal proper: opening entry, closing entry, transfer entry, adjusting entry, and rectification. I told we have done it in the previous session itself, and one more is miscellaneous entries. And this is all about this session number 12. And in case you want to have further readings or to gain further knowledge on this particular topic, you can refer this book, Accountancy by Dr. T.V. Raju and Dr. K. Sheshmurthy. And I sincerely thank uh, our Department of Collegiate Education and Bangalore University for providing me a good opportunity so that I can teach and help my students so that they can become successful in their studies regarding this. Once again, thank you all, and all the best to the students who will be viewing this and making use of this. Thank you.